Welcome to the Keiser Report. Markets, finance, scandal. Well, I see that Tim Geithner, Treasury Secretary in the U.S., is still walking free, even though he perjured himself in front of Congress recently. Watch this clip of Geithner confessing criminal negligence.
I've never been a regulator. Not a regulator nor a lawyer, unfortunately. So I'm not sure I can give you adequate answers to that, but I'd be happy to think about it a little bit and get back to you.
That's great, Tim. Tim, there's a cell waiting for you next to Bernie Madoff. Or you could go the way of Enron's Clifford Baxter. Think about it. Okay, now it's time for the Max question. Should Israel pay back the $60 billion in gifts it took from the United States? That's the Max question. Now, over the past 20 years or so, Israel has taken about $60 billion in gifts from the American taxpayer. But the law says that America can't make gifts to any country with a nuclear bomb program. And Israel has more than 100 nuclear bombs. Let's take a look at this clip.
Well, Israel is one of the loudest voices calling for a tougher line on Iran's nuclear program, but Israel's own nuclear capability has never been put to inspection. Even so, this is what is known. Israel has 2 nuclear research centers at Dimona and Sarek. Latest estimates suggest Israel's produced at least 118 warheads with weapons-grade plutonium.
Therefore, in all fairness, Israel should repay the money they took from Americans illegally. That $60 billion could come in handy now with so many Americans on soup lines and living in their cars. Plus, why do so-called Americans like Warren Buffett invest in Israeli companies that are breaking all kinds of sanctions? Doesn't he have enough money without aiding war criminals and illegal occupiers? What do you think? Send me an email, Keiser Report at rttv.ru. Keiser Report at rttv.ru. Now let's turn to political analyst Stacy Herbert for today's top stories. Stacy, welcome back to the Keiser Report.
Good to be here, Max. I have some headlines that relate to the disposable people in America and those people who are impossible to dispose of, the likes of Timothy Geithner and the top elite bankers.
Yeah, you can't get rid of Tim Geithner. He's indisposable. He's indisposed. Who else? Who are these disposable people in America?
Well, the headline reads, "The Disposable Worker. Pay is falling, benefits are vanishing, and no one's job is secure." Next headline, job openings at record low, 50% fewer than 2007. So the disposable workers are this increasing trend in America for just-in-time labor force. They're calling them just-in-time labor force. That's the, I guess, the fun, optimistic way to say day laborer. So these people have no health insurance, no retirement benefits, no sick days, and no vacation days. They have no rights. They could just easily be disposed of and let go.
Well, yeah, they're disposable. And but I think that a lot of these disposable workers in America are looking at that trend in Japan for the sex robots to go with their disposable income status. This way that they can kind of pair up having their own robotic disposable existence and having a, disposable wife or lover as well. So you've got an entire nation of robots. Japan should benefit from this, I guess. But we can't think of Americans as having rights at this point. That's all over with. That's done. What else?
Well, the article also points out that the income for the 80% of the workforce that is non-supervisory and in production, their incomes have declined by 9% in real terms since 1973. And so their incomes are going down, their benefits are dropping, and now you have something like 660,000 people lost their job last month. So this is creating conditions that are very dangerous for young workers. Their unemployment rate is far higher than those over 55. And so young workers are resorting to something called semi-permanent internships. They're working for free on a semi-permanent basis.
Look, you can't have capitalism without capital, and you can't have capital without people actually making real money. No, it's not capitalism over there in America. It's democracy. What do you call them? Temporary, estranged cogs in a machine cluster? Beep. What is it again?
Semi-permanent interns.
Semi-permanent interns. It sounds like something to relieve constipation.
Well, it also sounds like neo-feudalism. In the feudal times, you used to work for free. But at least you're master, your lord, would feed you and house you.
How's that suppository salesman over in the UK, David Cameron, doing, by the way?
Now we go to the replaceable, the unreplaceable, the people that cannot be replaced or disposed of, and that's the top 1%, you might call them.
Toxic waste.
The lords. The bonus boom, reads the headline. Now, if you check out this chart, you see the red line at top. That's the average Wall Street bonus. Now, the blue line, the flat line at the bottom, is the median household income, and this goes back to the 1990s. So as you see, it's been quite a boom time for those collecting bonuses on Wall Street. And bonuses this year are expected to be $140 billion. That's bonuses from 2009. So this is up about 40% since you see that crashed a bit from the peak in 2007.
All's well in the casino gulag known as America. Well, I suppose a lot of these disenfranchised, disaffected workers will spend their life savings on Japanese sex robots. So the Japanese sex robots can make more than the actual workers in America. Think about it.
And then my final headline, bankers in the hot seat. So these are those people who are impossible to dispose of, but they give these headlines for the disposable people at the bottom to make them feel a little bit better.
Like Geithner, right? You can't get rid of him. He's
yes.
like a bad rash.
Now, in the picture here you see it's Jamie Dimon, Lloyd Blankfein, CEO of Goldman Sachs, John Mack, CEO of Morgan Stanley, Brian Moynihan, CEO of Bank of America. So they're being called before the Financial Crisis Commission, which is set to is now publicly hearing testimony from banking CEOs to find out what happened, how the financial crisis happened.
Gee, I wonder. A bunch of CEOs colluded. They swapped credit default swaps, the basic unit of accounting fraud. They gave themselves billions of dollars, and they disenfranchised the country. Let's see. What am I missing?
Well, actually, one of the people on the committee is a woman who was an analyst at Merrill Lynch, and she's quoted in the article as saying something to the effect that we don't know what caused the financial crisis. It's still open to interpretation.
Well, the problem is, Stacy Herbert, is that they're attacking this piece by piece by piece instead of understanding that the Merrill Lynches, the Bank of Americas, the Jamie Dimons, Lloyd Blankfein, the rating agencies, Moody's and S&P, the investment banks, the investment bankers, and the analysts and the fund managers all put them together, and you've got a criminal syndicate. And until you attack this as a criminal syndicate, you're never going to actually get to the bottom of the criminality here. And these, as you point out, you can't get them out of the system. They are basically cancer, and there's no cure for Jamie Dimon and Tim Geithner.
Well, this commission, the Financial Crisis Commission, is being likened to the 9/11 Commission. So they say they're seeking accountability, like the 9/11 Commission. And recall, we just had this underwear bomber on Christmas Day. That guy got through because the 9/11 Commission report, their recommendations, none of them were followed through.
No.
Of course, it had no teeth. There were lots of big empty holes in the space of the 9/11 Commission report. So we could expect something like that with this financial services.
Another windfall profits for bankers as a result of You see, they point out the crimes, and what the bankers do is they just create insurance products to insulate themselves against their own crimes, and they make more money trading these products back and forth with each other, and they actually just make more money. So it's like trying to get rid of cockroaches by putting out a lot of Brett food crumbs on the floor as a way to deter the cockroaches from, infiltrating and infesting your kitchen. Basically, this committee, the show trial, is just a matter of feeding the cockroaches on Wall Street and the City of London. Let's not forget the City of London. Even more free money.
But, Max, you talk about show trials.
Yes.
There's another one coming up as well. House subpoenas Fed over AIG bailout.
House subpoenas Fed over AIG bailout, yes.
So California Representative Daniel Issa is, he was the one that got these emails from the New York Fed, which revealed that the New York Fed forced AIG to lie to the public and to the SEC about the dispersal of $62 billion in taxpayer money to Goldman Sachs and Societe Generale and a few other big banks. Well, now they're going to he's subpoenaed Timothy Geithner to appear before Congress and testify about this 100 cents on the dollar being paid out to the taxpayer, to the banks.
Yeah, well, this is the smoking gun, isn't it? Geithner caught red-handed. Not only did he perjure himself earlier by saying he wasn't a regulator when he was regulating the New York Fed. In fact, that's out, should be in jail right now for that. But now it's come out that during his stay at the New York Fed, Geithner was coercing the system to disgorge taxpayer money to help out his friend Goldman Sachs.
Now, Daniel Issa also asked Neil Barofsky, the Special Inspector General for the Troubled Asset Relief Program, TARP. And now Neil Barofsky wrote back to Daniel Issa and said, the Fed directed us not to provide you, Congress, with the document that it has provided to us. So according to the TARP program, the Congress has no say. The Fed only has last say. They can decide not to hand over any information to the Congress.
Look, Americans are like ducks on a foie gras farm. They just open their gullets and they just stuff lies down there until their livers are too big to sustain life, and then they pluck them out and sell them on eBay. It's disgusting. Stacy Herbert, thanks again for being on the Keiser Report.
Thank you, Max.
Well, it looks like more pain and gloom for the American worker, but plenty of upside for Japanese sex robots. We'll be right back after the break with Janet Tavicoli.
The United States of America is waging war within its own army. Till now, advantage is on no one side. And human losses are quite significant. Is it possible to win the war against sexual assault in the U.S. Armed Forces? Sex in the Army on RT. Every month we give you the future. We help you understand how we'll get there and what tomorrow will bring. The best in science and technology from across Russia and around the world. Join us for Technology Update on RT.
Time to welcome Janet Tavicoli, an expert in financial derivatives and author of Dear Mr. Buffett, What an Investor Learns, 1,269 Miles from Wall Street. Janet, welcome back to the Keiser Report.
Hi, Max.
Now, Janet, you're one of the world's foremost experts on credit derivatives, otherwise known as weapons of mass financial destruction, a term coined by Warren Buffett himself. Now, Frank Rich, over there at the New York Times this past week, says, quote, fluent as we are in Al-Qaeda and body scanners, when it comes to synthetic CDOs and credit default swaps, not so much. Janet, can you, as simply as possible, explain to the audience what a derivative is, how it is that they became weapons grade, and how many of them are there out there?
Well, you know, Max, Frank Rich is right. The problem there is transparency. And we haven't gotten that in credit derivatives. Now, credit derivatives are just derived from something else. That's what a derivative is. And credit derivatives are derived from credit risk, and we started out by creating it based on credit risk of bonds. So instead of buying a bond, you could sell credit protection. When you buy a bond, you're taking the credit risk. When you sell protection, you are taking the credit risk. So it's similar in that way, except the difference is you don't have to put up cash. And whenever you don't have to put up cash, you can create a lot of leverage, which just amps up your risk.
Okay, so basically we're talking about leverage, and you're talking about stocks and bonds, and you're talking about the ability to put up less than the face value or the quoted value, putting up a lot less cash, which gives you a lot more leverage, and a synthetic collateralized debt obligation. Tell us about a synthetic collateralized debt obligation. I mean, a collateralized debt obligation is already one level of a derivative. What is a synthetic level of a derivative?
Well, here's the thing, Max. If you look at a credit derivative, the problem with the credit derivatives wasn't the credit derivatives themselves. It was what was going on behind the credit derivative. So if you're writing credit risk against something that is tainted and you're doing it in a leveraged way using credit derivatives, you are just asking for a world of hurt. Now, we did it in the, not we, but America did it in the worst possible way. we were using credit derivatives to create phony securitizations. And I'm probably one of the few people saying these are phony securitizations. There should be fraud audits because it is not plausible that people didn't know what they were doing. And credit derivatives just allowed people to do it more massively and using leverage and doing it in a more opaque way, because now, in addition to the regular contracts, you also had credit derivatives contracts where you could pull a lot of shenanigans with that. And what that allowed people to do is actually short credit risk, hedge funds, investment banks, into collateralized debt obligations that were being sold to investors, and a lot of sophisticated investors didn't do their homework. But that also does not excuse an investment bank who knew or should have known that the securities were overrated and overpriced, and they didn't specifically point that out to the investors. Now we're in a situation where the public are the unwilling investors, and the public aren't sophisticated. So the argument that these were sophisticated investors and they should have known better doesn't hold water anymore. And I'm here to say that those credit derivatives were, to misuse a legal term, the fruit of a poisonous tree. And now we have a bunch of very sophisticated investment banks saying, gee, Janet, you were so smart, but we didn't know any better. Poor little us with huge staffs of professionals who are supposed to be the best risk managers of the world. They didn't know, but a little girl in Chicago knew. What BS.
All right, let's talk about Goldman Sachs for a second. You're in a bit of a shootout with Goldman Sachs over what they did and did not know and disclose about their synthetic CDOs. Tell us about how these instruments were used by Goldman to profit from the collapse of the products that they were also selling to the very same clients.
Yes, and it's not just Goldman. I want to point that out. In terms of underwriting, Goldman wasn't the greatest, but with respect to AIG, they were the key player with respect to AIG.
Yeah, but Janet, just a quick side here. I mean, Lloyd Blankfein of Goldman Sachs CEO, according to the Financial Times at the end of last year, is the man of the year. So why not, let's focus on Goldman Sachs. He says he's doing God's work. The Financial Times says he's the man of the year. It looks like he's actually the chief architect in a financial criminal syndicate of financial terrorists. But continue, please.
All right. I'm not going to leap to that conclusion. I'll let your viewers draw their own conclusion. But here's the thing. I talked to Goldman Sachs' spokesperson. Well, they actually called me because the spokesperson was concerned about what I was writing. And they start out with a threat, in the way that we civilized people threaten each other. They said, well, I don't have a problem with what you said, Janet, but our lawyers might. And I thought, okay, now you've got my attention. Bully me. Now let's continue. And within the course of a short conversation, it was a little over an hour, I felt lied to several times. For example, I said these securitizations that were coming out of Goldman Sachs alternative mortgage products, you knew or should have known that they were going to implode, that they were going to collapse. The collateral that went into them were second liens, a bunch of crummy collateral. So if you looked at a deal like Goldman Sachs Alternative Mortgage Products 2006-3, it's one that Alan Sloan of Fortune has written about, it was eaten through all the way up through the AAA level. And if you looked at the stuff that AIG was insuring, they were taking the triple B components, the single A, sometimes double A components, and sticking them into a CDO. Well, what's the problem with that? I just told you that the products that were coming out of Goldman Sachs Alternative Mortgage Product were eaten through all the way up to the AAA level. That meant the stuff that was going into those CDOs, the stuff, if there was anything similar to that, that would be worth zero. Now, a lot of people weren't crazy enough to put everything that was worth zero into these CDOs, but they knew or should have known that a lot of the stuff they were putting in was very troubled. Some of it was worth zero, some of it was worth a lot less than par, but it was all going into the CDOs to create a fake bid. And then Goldman Sachs was also doing this with credit derivatives, and those products are still on AIG's books. Those didn't go into the separate Fed vehicle. And I'm saying that all of that stuff is sort of, to misuse the legal term, the fruit of the poisonous tree.
Okay, so Goldman's excuse is that they were quote-unquote hedging their bet, but in fact they were acting as a predator and collapsing the market in a controlled demolition to make big bucks, as you would expect from a criminal syndicate. Now, getting back to Frank Rich's point, people listening to this interview will say, my gosh, that's a lot of interesting jargon. I don't really understand what's being said here. But my point, and Frank Rich's point, is that you really should familiarize yourself with this, what's going on in Wall Street and the sophisticated language that's being used, because it is, as Frank Rich of the New York Times saying, more destructive to the U.S. economy than anything Al-Qaeda is cooking up now or ever will. This is actually the basis of terrorism in America is financial terrorism, and as Frank Rich says, you should familiarize yourself with what's going on here. Forget about the body scanners. Forget about the, the underwear bomber. This is the fight.
Well, and that's why I wrote a book like Dear Mr. Buffett, so the average person could see the sleight of hand that went on there. This is just similar to card cheats. And I don't know why these card cheats aren't being escorted out of the gentleman's club. You know, if I look at these deals, Max, another thing that Goldman tried to say is, oh, you knew better, but we didn't. Well, the average person might believe them. But, if we were on the moon, and I took this structured finance book and this $100 trillion Zimbabwe dollar, which is where our dollar is going, and I dropped these things from a height, the average person might say, gee, which one is going to hit the ground first? The average person wouldn't know the right answer. But a first-year physics student does know the right answer. The right answer is if you're on the moon and you drop these from a height, they're going to land at the same time. Well, if I'm a securitization professional and I look at the kind of deals Goldman was putting together, you know or should know that they had a problem. And Goldman's trying to fool the average person who doesn't know any better to saying we couldn't know. That's BS. You have to hold people to a certain level of understanding, a certain level of competence. And I'm saying that if you're that incompetent, then you aren't the risk managers you claim you are. Because if you had done even a minimum amount of due diligence on that collateral, you knew or should have known that those ratings were completely misleading and false, and that you were selling things under false pretenses.
Well, okay, it's a controlled demolition of the financial markets, as we've seen in other areas of the terror spectrum, and Goldman and J.P. Morgan and the whole crew are really should be in The Hague and brought on charges of terrorism and tyranny and dealt with accordingly.
I agree with you. There should be some remedy because, look what has been done here. Look at the Zimbabwe dollar. Why are we allowing destruction of our currency, or certainly allowing a huge wealth transfer within the United States, and there are no consequences?
All right, let's talk about AIG's collapse and the role of that other legendary crook from the loins of America's crooked administrations, Timothy Geithner, when he was at the New York Fed. I'm about to throw up here, but I hope I can get through this without actually throwing up. But tell us a little bit about Geithner and his crooked ways at the AIG collapse.
Well, Max, Timothy Geithner was at the Fed when the initial $85 billion credit line was approved. And now he's trying to say that when the assets of AIG were bought for 100 cents on the dollar in November, he had nothing to do with that. Well, he had everything to do with the bailout. So, for him now to claim that, yes, I was the president of the New York Fed at the time that these decisions were made, but I can't be held accountable for the way that the bailout proceeded, that's like saying, yes, I was there, but there was no there.
Now, you know what his excuse is? His excuse is that he was part of the transition over to the Treasury, and he had no idea what was going on. He was part of the transitionary team. So we're supposed to treat this like a 6-year-old at a birthday party that he missed his ice cream and cake because he was in the bathroom taking a leak. This guy's pathetic.
Max, he's distorting the timeline because the initial bailout in September of 2008, he was there. He was right on board for it. And the Treasury and the Fed agreed that the AIG bailout should proceed. And, of course, they agreed because Steve Friedman was chairman of the board of the New York Fed, and he was also on the board of Goldman Sachs, and Hank Paulson was secretary of the Treasury at the time. But Timothy Geithner was in that all the way in September of 2008, which was when the initial bailout began that opened the door for all the rest of it. So for him to, moonwalk back from responsibility is pretty ridiculous. And if he can't own his own decisions, then, he doesn't deserve to be in any public office.
I'd like to see Tim Geithner moonwalking. I think, I'd give him a break. He grew up up less than a mile from where I grew up out in Westchester County. Everyone in Westchester is ashamed of this poor soul from our town that's turned into this horrible criminal banker. Now, you've got the Fed, the New York Fed wanted AIG to hide these synthetic collateralized debt obligations. We know that from the emails that have been made public. What exactly is hiding in the synthetic CDO?
Well, Max, it's not just the synthetic CDOs, it's also the cash CDOs. And if the credit derivatives had been based on righteous securitizations, there wouldn't be a problem. The problem was that what they were referencing was phony stuff. So credit derivatives are just a means of risk transfer. And by the way, the referencing crummy stuff was also true of the cash securitizations, and there are a lot of those that were phony. A lot of asset-backed commercial paper that ended up in mutual funds backed by phony collateral.
Well, anyway, what I can recommend for people following along at home, pick up Janet's book, Dear Mr. Buffett, because it explains in great lucid detail where all the bodies are buried, and you can spend a whole weekend having fun connecting the dots as to how Wall Street murdered Main Street. And I give you all the juicy details. So that's going to do it. Thanks for being on the show, Janet.
Thank you, Max.
All right, Janet Tavicoli. Now I want to thank my other guest, political analyst Stacy Herbert, for being on the show, as usual. And remind you that if you want to write us an email, the address is keiserreport@rttv.ru. That's keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.